Even more reasons to pay down your mortgage and not carry debt in your portfolio, your investment portfolio. This whiteboard I'm going to share with you because this actually is affecting me, or something that is not affecting me, but certainly something I think about quite a bit. A number of you had written me this sent me this article from Morningstar, Christine Benz, the expert forecast long-term stock and bond returns 2020 edition. I made reference to this earlier in the video I was talking about where climate change means, or climate risk equals investment risk. It was silly. But anyway, I do want to, and I'll get into this article at a different date, maybe tomorrow. But I want a part of this article jumped out at me. Christine says in the very first paragraph, the S&P 500 has gained more than 13% since 2010, while the Bloomberg Barclays Index U.S. Aggregate Bond Index has returned a less princely but still respectable 3.5%. Interesting, is it not? So that bond index has averaged 3.5% over the last 10 years. 2010 to end of 2019 is 10 years. All right, so that made me think, what was the 10-year yield on intermediate bonds, the Treasury bonds doing back in 2010? And if we look at treasury.gov, and we can look back and we see treasury.gov, current daily Treasury yield curve rates. We can see in 2010, the average, they start off at 3.85. They went down to June, they were down to 2.96, 2.52, 2.47, came back up at the end of the year at 3.3. So I can say the 10-year Treasury bond was at about 3.5 roughly, which happens to be almost to the penny the actual annual yield on your bonds that you have in the last 10 years. Thus, more proving of my point, you only get what the bond yield is when you buy it, or if it's at par bought initially at issue date, you get par value. I cannot stress this enough. We have perfect evidence of this. 3.5 is a 10-year Treasury. It's what the aggregate bond index paid. I can almost assure you that's an intermediate bond mimicking in terms of duration, average maturities, whatnot. 3.5 was the average yield back in 2010 on the 10-year Treasury, and lo and behold, that's what you got. Now, people say, well, Josh, and I already looked at this, the long-term bond has averaged significantly higher than the long-term rates, 30-year Treasury. Well, because we still have 20 years left for those to mature, so I don't want to get to that anyway. Remember, though, whatever your current yield is what the rate you're going to get on your bond. There's just no getting around that. So we know for a fact, we can extrapolate what basically just this to more prove my perspective, my point. Again, what you're getting as a yield on your current yield on your bond is pretty much what you can take to the bank for your return on your bonds that you have in your portfolio. All right, so now we take, here's a current 10 years at 1.75. Here's a current 30-year at 2.2. These are 30-year and 10-year Treasury bonds, so the safest bet there is. Here's a current year 10-year, roughly AA rated corporate bond, paying 2.94. We can even round that up and say 3. So that's a AA. This is from the Fed of St. Louis Fed, by the way, which uses a conglomeration of AAA, AA, and single A rated investment-grade corporate bonds, all with a 10-year maturity, and right now is paying about 2.94. So we know, and given what I just told you about the data, 3.5 is what you're getting 10 years ago. 3.5 is what you got over those 10 years on an annualized basis. So if you invest in 10 years, you're going to get 1.75. If you invest in 30 years, you're going to get 2.2. And you invest in 10-year corporate bonds, which are more risky or riskier than government bonds, you're going to get about 3, roughly. We know that. All right. Now, my mortgage interest rate is 3.25. This is what I have. I have an ARM at 3.25. Should I refinance all that? Look, we can get into all that later. But right now, I got 3.25. All right. Now, the question that comes, what a lot of people do, a lot of snake oil salesmen or people who are just ignorant, and again, I'm never quite sure which is worse, ignorance or snake oil, or ignorance or being nefarious. But anyway, they'll say, oh, you can get 3.25 minus 25% tax deduction on your interest, which you don't. I'll get into that in just a second. So their argument is you'll get 3.25 minus 25%. It's only cost you 2.43%, Josh. 2.43 is your total cost. But that's not true because I am not getting a full deduction on my entirety of my mortgage interest. And what I mean by that is because of my wife and myself, we have standard deductions roughly $25,000. All right. Now, for me to get a full mortgage interest, that means I'd have to have significantly more than $25,000 of itemization. This year, I'm going to have about $32,000. All right, and some of that's property taxes, some of that's mortgage interest. But what I'm trying to say is I already have $25,000 of standard deduction without having to itemize. The point is, the vast majority of you guys are not going to have itemizations. You're not going to have any itemized deductions. Thus, it's all standard deduction. Thus, you're not going to get this right here. You're not. Any banker who says you can write your mortgage interest off, I'm telling you right now, run for the hills, because they should put a huge asterisk that says most people will not, because the standard deductions are so high. So because of that, we know the true cost to us on this mortgage is 3.25. All right. Now, for me, again, I can write off about $7,000 more than my standard deduction because high property tax, high mortgage interest. We do give some to charity and whatnot. But it doesn't mean I get right to all my mortgage interest off. It just means, if anything, I get to write $7,000 of my mortgage interest off because that's above and beyond what my standard deduction would be. So you're not. So at the end of the day, that's the true cost of your interest here. All right. Now, the drawback here, here's the bonds. All right, so what happens? What's the inflation rates doing? So let's take a gander, shall we, at the current, we'll go to U.S. inflation rate, which is about 1.75 or so. Let's see, Trading Economics is always the website I like to go to. Let's see what we got here. 1.7. All right, so right now it looks like the current, this is from U.S. 2.1, 2.3. All right, 2.3 is what it was. The annual inflation rate for the U.S. in 2019 is 2.3. It's actually higher than I thought. All right, so this is what we're getting. All right, but then you have to look at taxes and you have to look at inflation. All right, so what's happening here is we have 2.3 is inflation. But we're also going to lose tax on this. Now, I'm just telling you, hang in there, because we're going to say we're going to pay 25% taxes. Minus 25%. And that's state and feds. All right. So we're going to pay 25% state and feds. That's what we're going to say. Now, you can say, look, these are in IRAs. That doesn't matter. It's still coming out as ordinary income. It might not come out today, but it's still coming out as OI. Tax as ordinary income. So literally, you are paying 25% tax rates regardless if it comes out now or later. There's no compounding in bonds, by the way, so you can't say, oh, I'm getting compounding growth on that. Unless you're taking the interest you're receiving off those bonds and reinvesting in stocks, there's no compounding. So what's happening here is you're paying 25%. You're only getting that interest rate. It's just a matter of when you're paying the tax on it. I hope that makes sense. Now, you could make an argument once you retire, your tax rate will be lower than it is today. You could make an argument it'll be higher. It really depends on your situation. But we're just going to do even Steven, 25% here. You're not writing off 25% there. You're going to pay tax either today because you have it in a taxable account or tomorrow because you have it in an IRA. So 1.75 minus 25% is you're getting a total of 1.3. Let's see if I can do another color here. Let's see if this one works. 1.3 is what your total interest rate before tax. So I don't know if that's dark enough. Let's see, do I get reds in there? Yeah, I got red. Let's see if this one works, all right? So now we got 2.2 minus 25%, 1.65. Well, there we go, 1.65, yeah, 1.31, 1.65%. 2.94 minus 25%, 2.2. All right, so that's our after-tax rate of return. But then you got to factor inflation, which is minus 2.3, all right, minus 2.3, minus 2.3. And so we got 2.2 minus 2.3, we're getting a negative, that's going to equal a negative 0.95 negative, all right? So 1.65 minus 2.3 is a negative 0.65%, negative 0.65%. And then, you okay in there, big man? Then we got 1.31 minus 2.3, so negative 0.99. All right, so what's happening here is if I just carry my loan and keep my bonds, the difference between 3.25 minus minus point negative 99 is that what it would be? Is that's a 4.25% difference in interest rate. So it basically cost me 4.25. Now some people say, but Josh, you're also inflation is eating away at the mortgage interest, and no, it's not. It's actually increasing the value of my home is what's happening here. So your home is worth $100,000 is inflated by 2.3%. 2.3, 2.3, 2.3, whatever the rate of inflation is. So it doesn't really have any effect on my mortgage. It's still the cash flow I have to take out. But it gets worse. So it's cost me it's cost me 4.25 in which to keep this mortgage. And on top of that, it's a losing situation. So I'm losing 4.25 by keeping my mortgage and keeping my bonds. But it's worse than that. Because now I got to generate enough cash flow in which to pay income tax on that 3.25. And we're just going to say it's 30%. And we're going to say I'm a 30% tax bracket. So 30%, if I'm in a 25% tax bracket, that means I need $40,000 in which to pay this interest rate right here. You see what I'm saying? So now I need $40,000 if my mortgage payment is $30,000. Does that make sense? So let's just say my mortgage interest is $30,000. That might be too high. Let's say my mortgage interest is $15,000. That means I need $20,000. Let's do that instead of 40. That means I need to generate $20,000 of income in which to pay $15,000 of mortgage interest. I need to generate $20,000 to pay $15,000 of income because that $20,000 would be taxed at 25%, just to keep everything simple. So not only am I down 4.25% a year, I'm losing 4.25% on my investments relative to mortgage, but I need to generate $20,000 in which to pay 25%, which means by 3.25, you got a 3.25 divided by 0.75. That means it's 4.33. It's the true cost is 4.33. So 4.33 plus 0.99 means it's cost me 5.32 to keep the mortgage. That's crazy. I'm out 5.32. Keeping the mortgage has cost me 5.32, even though it's only 3.25. Not a good proposition at all. I'll get more into the Morningstar analysis of what they talked about through the various firms, their investment outlooks. I frankly could care less, but you might like to see it. Hey, buddy. Anyway, so Pablo says, pay off your mortgage and earn 5.32% a year. Oh, yeah. So right now it's costing you 3.25. I'm saying if you pay off your mortgage, you'll earn 5.32. That's what I'm trying to say. All right. Hope this helps. If you have any questions for Pablo, just ask him. Say, Pablo, tell me, does the sun rise in the east or the west? Pablo, should I marry my girlfriend? Pablo, who do you think is going to win, Tennessee or Kansas City? Who do you think, Pablo? Tennessee? Okay, Pablo says Tennessee. Pablo, who do you think is going to win, San Francisco or Green Bay? Huh? Ooh, Pablo doesn't want to take a game. San Francisco? Okay, so we're going to have a San Francisco-Tennessee Super Bowl. You heard it here first from Pablo. We'll see you.